So, what in the world connects an old school gangster's laundry shops to a massive $81 million cyber heist? Well, the answer is money laundering. Today, we're going to break down the complex law that's designed to stop it, and we'll start with a true story that put the Philippines right at the center of a huge global financial scandal. All right, our story kicks off in February 2016 with a crime that was so bold, it honestly feels like it was ripped straight from a Hollywood movie. We're talking about a massive cyber heist that hit the central bank of Bangladesh and then funneled a fortune right through the Philippines. And in the process, it exposed some major cracks in the entire global financial system. And the amount they stole? Get this, a staggering $81 million. Hackers got into the Bangladesh bank systems, and using their credentials, they just started sending transfer requests from its account at the Federal Reserve Bank of New York. I mean, the sheer scale of this theft put regulators all over the world on high alert, like immediately. And the speed of this whole operation was just insane. Within hours of the hack, those stolen millions landed in 4 fake accounts right here in the Philippines. Then, over the next 4 days, that money was pulled out, swapped for local currency, and funneled straight into casinos, which, are notoriously difficult places to track money. And the craziest part? The only reason another $850 million wasn't stolen was because of a simple typo in one of the transfer requests. No joke. Now, you might be surprised to hear that this super modern, high-tech crime actually has its roots in something way more old school. To really get what happened to that 81 million, we have to rewind all the way back to the 1920s and talk about the original gangster himself, Al Capone. You see, Capone was making a fortune from all sorts of illegal stuff, smuggling, prostitution, you name it. But he had a problem: how to hide where all that dirty cash was coming from. His solution? He bought up legitimate businesses that used a lot of cash, like laundromats. By mixing his illegal money with the laundromat's everyday earnings, it became basically impossible to tell which dollar was dirty and which was clean. And that right there is literally where we get the term money laundering. And that brings us right to the official definition. See, money laundering isn't about making money, it's about cleaning it. It's the whole process of taking the profits from a crime, what the law calls an unlawful activity, and running it through a cycle to make it look like it came from a totally legit source. And criminals usually do this in 3 classic steps. First up is placement. That's just getting the dirty cash into the financial system. Think of the hackers wiring that 81 million into those bank accounts. Step 2 is layering. This is where they create a messy, confusing web of transactions to hide where the money came from. That was the fast withdrawal and swapping it all for casino chips. And finally, you have integration. The clean money is brought back into the regular economy, maybe to buy a condo or a luxury car, and now it looks totally legitimate. So the big question is, how do you even begin to stop something like this? Well, the Anti-Money Laundering Act, or AMLA, creates a kind of frontline defense by naming certain people and businesses as covered persons. You can think of them as the gatekeepers of our financial system. And this list has all the usual suspects, right? Banks, insurance companies, stockbrokers. But it also covers others who deal in really high-value stuff, like jewelry dealers, real estate developers, and, this is a big one, casinos. In fact, casinos were added to this list specifically after the Bangladesh bank heist showed just how big of a vulnerability they were. So what do these gatekeepers actually have to do? Well, the law boils it down to 3 main jobs. First, they have to know their customers, which means verifying who they really are. Second, they have to keep detailed records of transactions for at least 5 years. And third, and this is probably the most important, they have to report certain kinds of transactions to the government. So, what kind of activity actually triggers one of these reports? The law basically sets up 2 different kinds of tripwires. One is based on a simple dollar amount or peso amount, and the other is based entirely on weird or suspicious behavior. And this is a really key difference. A covered transaction is automatic. A transaction goes over a certain cash limit, boom, it has to be reported, no questions asked. A suspicious transaction, on the other hand, can be for any amount. It gets flagged because it just doesn't make sense. Like a low-wage worker suddenly getting huge monthly deposits, or someone making deposits every single day that are just shy of the reporting limit to try and fly under the radar. For most banks and financial institutions, this is the first tripwire. Any single cash transaction that's over 500,000 pesos in a single banking day, it gets reported automatically. But that number isn't the same for everybody. For industries that handle way more cash, like casinos, the reporting threshold jumps way up to 5 million pesos for a single transaction. And for real estate developers and brokers, the bar is set even higher at 7.5 million pesos. These different limits are there because they're meant to reflect what a normal amount of cash flow looks like for each of these industries. Now, when these reports are filed, they don't just disappear into some government black hole. They're sent to a really powerful government body that was created specifically to investigate them. And that's the Anti-Money Laundering Council, or the AMLC. And you can tell how seriously the government takes this just by looking at who's on this council. It's chaired by the governor of the country's central bank. The other members are the heads of the Insurance Commission and the Securities and Exchange Commission. I mean, these are the top financial regulators in the entire country. And this council isn't just for show. It has some serious teeth. If they find what's called probable cause, that an account is tied to illegal activity, they can go to the Court of Appeals and ask for a freeze order. This is a super powerful tool that blocks anyone from touching the funds in that account, and it can last for up to 6 months. That gives investigators crucial time to build their case. Okay, so at this point, you might be thinking, this is all just complex financial rules. But the real reason this law exists is to fight very real, very dangerous crimes that affect everyone's safety and security. You have to understand, money laundering is the lifeblood of organized crime. It's what allows criminals to actually profit from things like kidnapping, drug trafficking, and corruption. It's how terrorist networks pay for their operations, and how crooked public officials hide the bribes they take. If you cut off their ability to clean the money, you cripple the entire criminal enterprise. So when you boil it all down, the Anti-Money Laundering Act is about so much more than numbers and reports. It's really a national security tool. It's designed to protect the integrity of our country's entire financial system and make sure that it can't be used as a laundromat for the proceeds of crime, whether that crime happens down the street or halfway across the globe. Which brings us to our final big question. The world of finance is changing faster than ever before. As we all move towards a more digital, more decentralized economy, you can bet the methods for laundering money are evolving too. The challenge for regulators is to somehow stay one step ahead, which leaves us all wondering, are the laws that were built for yesterday's crimes going to be strong enough to handle tomorrow's?